My name is Keith Hook. I'm an Executive Vice President. I have worked at Citizens First Bank since late February of 2000, which was 2 weeks before the bank opened. The first week or two was chaos. The bank had not opened yet. We were still busy setting up computer equipment and software and getting forms. It was very paper-oriented back then, so we were still getting supplies in. And then it was just the anticipation of what was going to happen the day that the doors opened. Everybody was pretty excited. The doors opened, and at 8:30, the first customer walked in, and it was just madness from that point on. We had made contacts before with friends and family, and we had a ready-made customer base that was ready to open accounts as soon as we were ready. It was incredible how many customers came in, and we kind of did a soft opening, how many customers came in just by turning the lights on and opening the door. Just the growth was astronomical. For us to grow from 0 to 318 million in 24 years is a pretty big challenge. Originally, we had 10 employees with one building that was 2,500 square feet. We now have 3 locations. This building's 15,000 square feet, has been added on to twice. We now have 55 employees. We used to have a vault room full of paper. Now the vault room is empty and nobody has paper. I had started here as a commercial lender. I'd been a commercial lender for about 10 years before I came here. I'd known Tom Sinkson and worked with him previously. So he recruited me to come here. Since then, I've worked my way up in numerous positions and I ended up being an executive VP. This is just banking as it should be. It's been our motto since we started. We're a friendly bank. Everybody knows everybody. It's run by locals, owned by locals, and serves locals. They came up with this idea that there was a need for a bank in Clinton that was more focused on Clinton people and run by Clinton people. And that was the premise, and that's still what we serve today. The premise behind the bank was we take in local deposits from our local town and community, and then we turn around and reinvest those back into basically the same local community that we get those deposits from. And that's just the way you grow communities. The FDIC Insurance was established in 1933 during the pits of the Great Depression because of all the bank failures and when all the depositors were wiped out. It was a way for the government to offer a safety net so people felt confident in investing and keeping their money in banks. And that's really still needed today, as we've seen recently with a couple of bank failures. The bank that failed in California, 90% of their deposits were not FDIC insured. About 6% of our deposits are not FDIC insured. So completely different models. We pay interest on deposits, and then we turn those deposits into loans, and then we charge interest on that. And the difference between what we pay our depositors and what we get from our borrowers is what's called our net interest margin. It's the largest component of profits in local banks. And one of the metrics we look at for profitability is return on equity. The original shareholder invested money in this bank and they expect to get a return. The money that they invested is our equity, and we're required to maintain certain equity levels by the FDIC, and they base the returns on what percentage they get back. A national peer right now on return on equity for a bank our size is between 10 and 12% return. ROA is also another measure of profitability based on the size of your assets. We're at $318 million in assets. Peer group in Iowa, ROA is about 1.4%. So a bank our size should make approximately $3 million. What percentage of our loans are put out against our deposits? We are a lending bank. We make a lot of loans. Our loan to deposit is extremely high. Today, we're about 98% loan to deposit, which basically means of all the deposits that we have, 98% of them are put back into the local community in the form of loans. We've always run a high loan to deposit ratio, and it's a great way for profitability, but we believe in investing more in the community rather than in investments in stocks and bonds. I remember when I first started on Truth in Lending, which is a big regulation, it just come into play. And I just started in as a loan officer, and the older lenders were telling me truth in lending was going to be the end of banking because it was too difficult. Now you look back, and that was just another milestone. Regulations continue to change. It's ever evolving, and every day is a different day. And the larger we become, the bigger swings you get with customer base and deposits. And then it's just interesting to see the movement of money and loans back and forth. Clinton is blessed where we don't see a lot of the highs and lows in the economy. We don't get housing bubbles for the most part. We don't get large unemployments. Clinton's a very stable area for the most part compared to other pockets of the world. So we're kind of insulated from some of those, but you do get affected by things that happen nationally. We just see it at a decreased level. Clinton County is pretty heavily banked. I believe there's 17 financial institutions or credit unions in a county of 51,000 people. Community banks still have a place in 2024. Digital banking has hurt some of the community banks, but I think our customers still like hands-on experience of dealing with real people, and I think that's where we benefit. There's a lot of opportunities in banking. There's a lot of different careers. We have positions that need accounting backgrounds. We have people that need marketing backgrounds. We have customer service backgrounds. It's a good field, and it's a good way to make a living, and you get to interact with a lot of people. Citizens First Bank, member FDIC.